If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably. And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness.
Hello everybody, it's Tortoise Investing coming at you today with 5 dividend stocks that you can buy and hold forever. I feel like we have some great compounders today and some great sales going on some of these. Now, if you're new, please make sure to hit that subscribe button, join the 557 that have already done so. Hit that like button and comment down below. I greatly appreciate any and all support. Yins are awesome. Yins usually like these, and I like doing them. I like trying to find some deals out there. None of this is financial advice. Always do your own research and stuff before buying anything. Now, without further ado, we are going to be taking a look at Lockheed Martin, Tractor Supply, Hershey Company, Waste Management, and General Mills. Now, starting off, Lockheed Martin. Lockheed Martin's got an adjusted free cash flow yield of 5.38%. Has a dividend yield of 2.83% and a payout ratio of 43%. So all those metrics are perfectly fine by me. It's off its recent high of over $501. It was hovering around the 440s. As you can see here, 440s, 450s area. And then they announced that they are going to be making fewer jets. So that made the price go down a little bit. And $420, I gotta say, I really, really like it. I like where it's setting at. So if you take a look here, this is going to be throwing things off because it's got the 2023s in there. And it's not even all of it. So we'll take a look at everything quarterly. Quarterly, as you can see here, very consistent revenue growth, around 3.88% over the last 10 years. And if we take a look here at the free cash flow, 5.6% over the last 10 years. EPS growth, 9.65% over the last 10 years. Very nice, just up and to the right. And let's see, their debt. Let's go ahead and go back to annually. Their debt's $15 billion. Their EBITDA for that year of 2022 was $8.7 billion. So no issues there. Whenever I'm looking at companies and looking at their debt, I don't like a company that has 3 times more debt than their EBITDA. So let's see here, this is 8.7. So if this was, let's say 27, that would be over 3 times. Be a red flag for me, but it's not. So nothing there to worry about. I personally don't think it's an issue. Let's just take a look here at the yearly revenue chart very quickly. This is going to be throwing things off, so don't mind the percentages now. But if you can see here, just a nice regression line up and to the right. It's going to be the same thing with the free cash flow, just up and to the right. EPS, again, up and to the right. The 2023 numbers are going to be bigger here. I think it's only accounting for 1 quarter so far. But yeah, the dividend's been increased at a rate of 10% over the last 10 years. This is a nice little set of stairs that they got going on here. And that is some great compounding. They haven't been doing quite double digit, but high single digit increases over the last few years. Still, I like it a lot. And this is the thing I love. Shares outstanding have been decreasing at a rate of 2.47% over the last 10 years. 7.8% in the last year. They bought back 7.8% of their shares. That is amazing. And I'm hoping that they took advantage of that when things were on sale, especially on these dips. Like right now, I hope that they are just gobbling up shares. And the return on capital employed since 2018 has been 22% or higher. That's a very strong ROC. Now, next up, Tractor Supply. Tractor Supply's got adjusted free cash flow yield of 2.51%, dividend yield of 1.91%, and a payout ratio of 38.9%. They're off their recent high of, let's see here, around $250, right at it. The revenue's been increased at a rate of 11.78% over the last 10 years. Again, that's just up and to the right. Very nice. Free cash flow, right at 10% over the last 10 years. A nice little upward regression. EPS, just right in line with everything else, 17.72% over the last 10 years. Their debt, they have $814 million in debt. Their EBITDA is 1.78 billion, so no issue there whatsoever. They always have very little debt. I like that a lot. The dividend's been increased at a rate of 23% over the last 10 years. Bonkers. This big hike here is probably throwing some things off because from 2021 to 2022, they went from 52 cents to 92 cents. So that is like an 80% increase or something like that. Just crazy. But they did it, and their payout ratio is still right at 38%, so not bad. Their shares outstanding have been decreased at a rate of 2.57% over the last 10 years, 3% in the last year. So they are buying back shares. I love that. And the ROCE is increasing. 2019, 18.3%. 2020 it was 18.8%. 2021, 22.9%. And 2022, 23.4% ROC, return on capital. So that's growing, and I feel like 2023 this company is just going to be right in line with everything. It's just going to be going up to the right, and that's just how Tractor Supply do. Next up, Hershey Company. I love me some Hershey. Adjusted free cash flow yield of 3.71%. It's got a dividend yield of 2.27% and a payout ratio of 47.6%. This thing above 2% dividend yield, I'm all about it. I love that. It's off a recent high of around $276 down to $209, so it's almost $70 off right now from its recent high, and I have been just buying this every opportunity that I get. Revenue's been increased at a rate of 4.6% over the last 10 years. Over the last 2 years, though, more increasing. We got 13% average over the last 2 years. Free cash flow, 8% over the last 10 years. Over the last 2 years, almost 20%. So they are growing rapidly. The EPS over the last 10 years, 10.6% growth. Over the last 2 years, 13.8% growth. And their debt, they have $3.02 billion in debt. Their EBITDA is $2.06 billion. So again, no issues. They could pay that off very quickly. The dividend, take a look at the dividend increase at a rate of 9.41% over the last 10 years. Over the last 2 years, 15%. Awesome. They are increasing everything. Revenue is growing quicker. Free cash flow is growing quicker. EPS and the rate that they are increasing their dividend. Now, when it comes to shares outstanding, they don't really do share buybacks, so there's not too much to look at there. The return on capital employed, though, 19% in 2020, 20.3% in 2021, and 21.8% in 2022. And this company, again, I feel like their 2023 numbers is just going to be an even bigger increase on top of that. Now, next up, Waste Management. This is one I've been also kind of eyeballing. This is moat as can be. A lot of these are very moat heavy. Adjusted free cash flow yield of 2.25%. It's got a dividend yield of 1.78% and a payout ratio of 48.5%. They are off their recent high of $173, so right at $20 off their high. Revenue's been increased at a rate of 6.34% over the last 5 years. Similar to Hershey over the last 2 years, 13.7%. It's increasing quicker. Free cash flow, 9.52% increase over the last 10 years. Very nice, just up and to the right. You like to see that. And the EPS growing at a rate of 11.84% over the last 10 years. And over the last 2 years, 23.7%. Bonkers, crazy. The debt, they have $14.5 billion in debt. Their EBITDA is $5.4 billion. Again, falls right in line with the 3-time rule that I like to keep things at. And I like it. I like Waste Management a lot. Dividend yield, dividends been increasing at a rate of 6.73% over the last 10 years and at a rate of 10.34% over the last 2 years. So they are increasing right in line with their revenue and free cash flow, the bigger dividend increases. Shares outstanding, they have been buying back their shares at a rate of 1.12% over the last 10 years, 1.8% over the last year. So a little bit here and there, pretty consistent buybacks. And the return on capital employed, 9.4% in 2020, 11.8% in 2021, and 12.4% in 2022. So yeah, Waste Management, very nice. Next up, General Mills. I love General Mills. I love me some cereal. I'm a cereal fan. General Mills is off their high of, $90 down to $66. This thing's down almost $30 off of its recent highs. Free cash flow yield of 5.03%. It's got a dividend yield of 3.5% and a payout ratio of 50%. Take a look at the revenue. Revenue's been increasing at a rate of 5% over the last 5 years. Very nice. And 2 year and 1 year is right in line with that as well. Free cash flow. Free cash flow has been... This is a regression run up and to the right, so it is increasing. So I don't know why these are negative numbers. Either or, must be something up with Qualtrim. But yeah, they've been increasing over the last 10 years. You see up and to the right. The EPS been increasing at a rate of 4.44% over the last 10 years, 6.78% over the last 2 years. Again, this is a mature company. General Mills has been around for a while. Their debt, they have $9.61 billion in debt. Their EBITDA is $3.2 billion. So again, that still qualifies right in. And the dividend, take a look here, has been increased at a rate of 4.5% over the last 10 years. They did pause it. It looks like in 2017 through 2020, but have now been increasing at a rate that is around the upper single digits, 7.56% over the last 2 years. So, I mean, it's on sale. This is a great company. The shares outstanding been decreasing at a rate of 1.01% over the last 10 years, so not too much going on there. And the return on capital employed, 11.11% so far this year, 15.07% last year. So pretty reliably above 10% on their ROC. So yeah, there are 5 strong dividend companies. I like all these. Again, do your own research before buying anything. I hope you enjoyed that. Make sure to hit that like and subscribe button for more. And until next time, see yous.